Hook, what if I told you the Mexican peso isn't just bouncing back, it's sending a warning shot to global investors? Yep, this isn't just about currency swings. It's about how one emerging market's quiet revolution could reshape everything we think we know about risk, interest rates, and who really holds the economic power in 2025. Let's unpack why the peso's 25-month high is way more interesting than your average Forex chart, /N/N context. So here's the headline: Mexican peso hits a 25-month peak against the US dollar. Boring, right? Wrong. Because the real story isn't just in the numbers, it's in the why. See, the peso isn't rallying because Mexico suddenly fixed all its economic problems overnight. No, this is about timing, global chess moves, and something I call the interest rate seesaw between Washington and Mexico City, /N/N. Key idea 1. The U.S. inflation mirage. Let's start with the obvious: everyone's waiting for U.S. inflation data. The Fed's next move hangs in the balance. But here's what fascinates me: why does a single CPI report have this much leverage over another country's currency? Because the dollar's dominance isn't just economic, it's psychological. If U.S. inflation cools to 3.4%, the market will instantly price in slower rate hikes. And that, friends, is where the peso wins by default, /N/N. What many people don't realize is that emerging markets like Mexico thrive on relative stability. If the Fed pauses, Mexico's 6.5% interest rate suddenly looks like a golden ticket. Imagine being an investor. Do you park cash in a 5% US account, or a 6.5% Mexican bond? The math whispers one answer, even if your gut screams risk. /N/N. Key idea 2, Mexico's quiet economic reinvention. Now let's zoom in. Mexico's industrial output only rose 0.2%, but here's the twist: it beat expectations. And that's the fourth straight month of underreported strength. Why does this matter? Because it's not about factories cranking out cars. It's about perception. Every small beat chips away at the fragile emerging market narrative. Personally, I think this is Mexico's quiet quitting the developing economy label. They're building something more resilient here, /N/N. But wait, why isn't US dollar to Mexican peso crashing past 17.00 then? Because traders are playing a high-stakes game of chicken. They're hedging against a Fed that might still surprise. This isn't just a currency pair, it's a battleground for two conflicting visions of the future, one where inflation dies quietly, and one where central banks keep fighting, /N/N. Key idea 3. The technical trap. Check the charts. US dollar to Mexican peso is flirting with oversold territory. Textbook analysis says a bounce is coming. But here's where I'll go against the grain. What if this isn't a technical rebound but a generational shift? The RSI at 29.4 isn't just oversold, it's screaming that the dollar's grip on emerging markets is fraying. If the peso holds 17.07, we could see a cascade toward 15.65. That's not a prediction, it's a possibility space, /N/N. Deeper insight. The geopolitical X factor. Let's zoom out. Oil prices, nearshoring, remittances, these aren't side notes. They're Mexico's economic wild cards. When U.S. companies reshore supply chains to Mexico, they're not just avoiding tariffs. They're creating a parallel economy that's hyperlinked to American stability but priced in pesos. What this really suggests is that Mexico is becoming the first developed emerging market, a hybrid beast that defies traditional categories, /N/N. Here's the paradox: Banxico's mandate to control inflation at 3% is both a strength and a vulnerability. By anchoring rates at 6.5%, they've created a self-fulfilling prophecy. Higher yields attract capital, which strengthens the peso, which helps control import inflation. It's a virtuous cycle, until it's not, /N/N. Closing thought. So where does this leave us? With a question that keeps me up at night: is the peso's rise a temporary glitch in the dollar's hegemony, or the first tremor of a tectonic shift? If you take a step back, this isn't just about Mexico. It's about how emerging markets are weaponizing high rates and strategic geography to rewrite the post-2008 playbook, /N/N. What's your take? Is Mexico the new safe haven in disguise, or are we all just missing the iceberg lurking beneath these charts? Let's dissect this in the comments, because in 2025, the most important economic stories might just come from south of the border.